This week, I'm going to start with what I think is perhaps the main topic that I want you to know from this course. We're probably going to climb the steepest hill in the entire course today. And I'll make sure that no one gets behind, that we're all together, we all climb to the hill together, and then we'll see the landscape we see from that hill. This hill is the hill of option pricing. And I'm going to do this organizing my discussion on episodes. We're going to go step by step. I'm going to break down the whole thing into little baby steps. Each baby step maybe 10 minutes, half an hour, something like that. And I want to make sure that we're all together there. Episode number 1 is option pricing. And I am going to play a little game. I'm going to do 2 trades today, 2 trades. And I need 2 volunteers to play with me. I got one here. What's your name?
Henry.
Henry. There you go. I forgot. Oh. Yes. Oh, you're a volunteer? You want to play with me? Yeah, you play a second game. I start with Henry, okay? That's number 1. You're number 2, okay? So, Henry, we're going to play a little game. The game is as follows. I'm going to flip a coin. No one flips coins anymore. No one has coins anymore. But I want to flip a coin. You know what I mean by that. And if heads shows, I give you $1. And if tails show, I give you nothing. Yes? Great. And we're going to agree on the price. I remind you, for about a month and a half, we're all going to work for free. Okay? We aim to not lose money, not make money. We're going to stay in a world of some sort of fairness, whatever that may mean. Do you agree? Great. Okay. And it's a good coin. It's not a biased coin. It has a 50% chance of giving me heads, 50% chance of giving me tails. And how much do you pay?
50 cents.
50 cents. Since we're playing not to make money, I agree. We're going to play. And you pay 50 cents. What happens when you do that? When you pay 50 cents, we flip a coin, and the price is 50 cents, that's what you're going to pay. And sometimes I make, sometimes I lose. Sometimes you make, sometimes you lose. On average, we know by the law of large numbers and variants of it that on a relative basis, taking into how much we play, we're going to more or less converge to the average. So you will be on average okay, and I will be on average okay on a percentage basis, right? Of course, after we play 1,000,000 times, it could happen that you could have made, and you know this from probability, you probably, or I could have made maybe $1,000, something like that, right? But $1,000 compared to the $1,000,000 we have put at stake somehow converges to 0. So the difference is going to work. And you are familiar with this game. This is a game of probability, and you've played this game before, yes? And you've learned lots of things about this. Maybe you've learned Markov chains, stochastic processes, and this and that. Yes? Good, thank you. So we played that game. Now, with you, I'm going to play a different game. I forgot your name. Kira. Kira.
K-E-R-A-T.
A-D. Oh, Kirat. Okay, Kirat. Okay, good. Good. You have the mathematics sweater, so you're a perfect partner for me to play with. Kirat. So we're going to play, looks like the same game. I have a certain asset. Now I'm going to make it more complicated. I have a certain asset. It could be a stock. It could be a car. It could be my house. Doesn't matter. An asset which is worth $1. And Henry is going to flip a coin, and if head shows, the value of my asset is going to go up. It's going to go to $2. And if head shows, the value of the asset is going to drop to 50 cents. Okay? But it's also a 50-50 probability that it goes up or it goes down, governed maybe by the same coin as Harry and I were using. We're going to play the same game. If the But I'm not going to use the terms of probability. I'm not going to mention the coin anymore. I'm just going to look at the asset. If the asset goes from $1 to $2, I give you $1. And if it goes from $1 to 50 cents, I give you nothing. How much do you pay? Help her. How much do you pay?
Wait, sorry, so the asset has a 50-50 chance of going to $2? Or?
Correct. It's exactly the same. I'm wrapping the probability game into a financial game. I'm not changing the probabilities. Thank you. Say 50 cents. It's not 50 cents, obviously, right? But say 50 cents. It helps me create a story, okay? So you pay 50 cents. 50 cents is the wrong price. But thank you. No, thank you. If you had said something else, I would be in trouble, okay? So thank you for that. Thank you for saying 50 cents, because everybody thinks it's 50 cents. Of course, I've said it in such a mysterious way that you're all thinking, well, maybe it's not 50 cents. It cannot be 50 cents. Otherwise, I would not be presenting like I am. And putting you in that situation of doubt is my objective. Okay, I want you to suspect something is happening. Maybe some of you already know what's happening. I mean, I have videos on YouTube, maybe you've seen it. Okay, but I'm happy that you said 50 cents because the price is not 50 cents. In your case, it's 50 cents. There's no question about that. And yours is not 50 cents. Why is it not 50 cents? I want you to think like this. You're going to think like financiers now. You're not going to think like gamblers. Very important. Some people think finance is gambling. It's not. We're going to learn that today. We're going to learn to think like financiers, not like gamblers. And that's the main lesson we're going to learn today. So imagine it's 50 cents. Imagine you pay me 50 cents. Okay? You all understand? You're going to give me 50 cents, just like Henry gave me 50 cents. But in this case, when you give me your 50 cents, what I'm going to do is I'm going to borrow money. Muskan, you're at my bank. Oh, you're right there. Yes, you lend me 50 cents. Yes? So you lend me 50 cents. So take your 50, and I borrow 20 from you. And with those, what I do is I buy 70% of the stock. I have exactly 70 cents, so I can buy 70% of the stock. If some of you say, oh, percentage of the stock, I've never seen that before. This is fractional ownership. This is very interesting. I need a blockchain for that. It's okay. If this, let's do math, okay? This could be in the millions of dollars, and then you buy 70 million. You know, let's not get sidetracked by rational numbers, okay? I buy 70% of the stock, and I wait. And then I see where the stock goes. If the stock goes up, I give you $1, but I'm very happy because my 70 cents becomes $1.40. I return your 20 cents. Remember, no one is making money, but I'm making money, 20 cents. That's my profit. Well, you may be thinking, well, if tails show, what happens in that case? If tails show, what happens is my 70 cents become 35 cents. I don't have to pay you anything. That was the game. I give you nothing. I return your 20 cents, and I make a profit of 15 cents. Something is wrong. I'm suddenly making money all the time. This is the most important thing to learn today. What happened? What happened? I want you to think about this. I would even give you a minute to think about it. What's going on? Needless to say, we can play this a million times, and whereas in your case, in a million times, maybe I make 1,000, maybe you make $1,000. Here, if we play this a million times, I'm going to make at least $150,000, guaranteed.
Mm-hmm. So what is option premium?
Okay. you're using a term that I have not defined yet, option premium, and I don't want to answer your question because I want to define the option premium first. So I only want to address this from this perspective. It's very important that you understand everything very well from the beginning. Some of you already know what I'm talking about, but I suspect that you know what I'm talking about from a very mechanistic perspective. Maybe you know some of these terms, and I don't know if you understand them. So I want to make sure today that all those terms that we understand exactly what they are.
Because it's written on the page, the option premium. Sorry. That's what she pays. The 50 cents that she offers me. Sorry. You were asking me about what's written there? Okay. The option premium, that's how I call the 50 cents that she paid me. She was willing to pay me 50 cents. Okay, that will be called option premium later. I should not have used that term here. It's too early. Okay, that's the option price. Okay, that's the option price. It'll be called a premium later. So sorry for my statement. Yes, that's what she agreed to pay. Okay. Yes.
So here, since the good case is it doubles, and then the bad case is it halves.
Yeah.
Your expected value would be above your one.
Correct. So that's a very important observation. Let me tell you, it's not too relevant. For now, it'll be extremely relevant in about an hour. But right now, it's not very. What he's saying is that, wait a minute, if the stock has a 50% chance of going up and a 50% chance of going down, the expected value of the stock is $1.25. That's what he's saying. Something wrong with that? Something wrong with that? It's mysterious, maybe disconcerting, maybe something that we don't understand. But actually, it gives us a hint. The hint is perhaps, and let me tell you, the hint is the one lesson we need to learn today, which is probabilities should not price anything. And in this case, we already see that probabilities don't price the stock. So if they don't price the stock, why would they price the game? Right? So this observation, this remark, gives us a certain amount of agnosticism. We certainly don't believe in probabilities. Yes? Which is what I want you to realize. Probabilities suddenly become useless. Yes? Okay, so if probabilities are useless, then what's useful? Let me do the following game. Kirat, we're still playing, but you paid 50 cents. I'm very happy, very, very happy, right? But then everybody else is watching this, right? So maybe I ask again, how much would you pay? I think you're all realizing that 50 cents is too much, right? Yes? So, 40 cents? If you go to 40 cents, I can actually do the same argument, and I will still make money for sure.
I think the option, the amount of the premium doesn't matter. I think it matters that you don't have loans.
That I don't have?
That you don't borrow loans.
Oh, no. See, the thing is that because borrowing, I mean, again, we're in a financial world. Okay, if you prevent borrowing, if you prevent me buying the stock, if you start giving me legal limits, then things will change. But if we are in a financial system where I can buy and sell, right? And in this case, what I'm doing is I'm actually selling a bond. That's what I'm doing when I borrow for you. So, of course, if you prevent me from buying and selling, then again, we're away from the world of finance and back to the world of gambling. And this is key. Because in finance, we can buy and sell. In gambling, you cannot. In fact, maybe at some point I will tell you, actually, the main reason I'm going to Miami today is because some of these markets are now beginning to be markets where you can buy and sell. I'll give you an example. You're too young, but anybody has home insurance? I have home insurance. You have home insurance? Okay, so if your house burns, no one really benefits from it, right? But if you have flooding in your home, maybe the flooding in your home is because there's a lot of rain. And if there's a lot of rain, there are people who benefit from a lot of rain, right? So there are some protections that you can, in the future, we may be able to get cheaper insurance because someone is willing to buy those risks, right? And this goes to the heart of what we're doing here, but we're at the very beginning. We need to understand this thing very well so then we can do very sophisticated things. So the thing that we have learned, I hope everybody here has learned, that probability is very misleading, and certainly 50 cents is not the price that we pay. Okay? So why? Let's go through the thing. One side always wins, guaranteed. In the case was me. And the more we play, the more I make. So there's no convergence to some sort of an equilibrium or something. No, every time we trade, I make money. So the price of 50 cents leads to making money for free, something that we call arbitrage. I may have mentioned that term yesterday. And we realize that this is a financial game. This is not a probabilistic game. So we have to play differently. We're going to think about this in different ways. The right price is a third. I'm going to just tell you and surprise you. I mean, I'm using foresight. I'll show you how you can derive with the predator. Why is it a third? Because if the price, option premium, is a third, if the price you pay is a third, where I go is I go to Muscan, right? I go to Muscan and I borrow another 33 cents. And then with that, I buy 2/3 of the stock. And when I buy 2/3 of the stock, I wait. If the stock goes up, I have $1 to pay you, and I have 33 cents left, which I use to return your loan. And if the stock drops in value, my 2/3 of $1 becomes 1/3 of $1. I have to pay you nothing, but I have to return my loan to you. So I break even. The price is 33 cents. Okay? Is this clear? The price is 33 cents. Now, do you see a relationship between this and what we did last week? In the language of last week, what I have done here is I've created a replicating portfolio to our game. I've come up with a strategy that gives me exactly the same cash flows. The difference is that last week we were dealing with deterministic cash flows, and today we're dealing with stochastic cash flows. But the result is the same. I buy and sell something, which is I buy 2/3 of the stock and I sell 1/3 of a bond. That's what I buy and sell. That's my portfolio. That will cost me something, which is what you give me. So it matches that cash flow. And it matches the cash flow after the period of uncertainty, and it matches exactly what I have to give you and the value of my portfolio, which is the return of the loan. You see? So this is actually the same as what we did last week. But we're using this in a stochastic environment, not in a deterministic environment like last week. So portfolio replication works not only when you have deterministic cash flows, but also perhaps when we have random cash flows. Are we beginning to understand this? There's a lot of questions now. Oh, how did I know it was a third? How do I construct this replicating portfolio? How this, how that? We're going to answer all those questions today. By the end of the day, you'll be experts at all of that. And if my time allows and your energy allows, we will actually be able to see that from here. We'll actually price anything. We'll feel so incredibly powerful by the end of today because we'll understand everything. But we have to go step by step. Okay? We call this arbitrage free. Arbitrage is making money for free. We don't like that. I told you, for a month, we're not going to We're looking for arbitrage-free situations. We don't want, when someone makes money for free, we don't like it. In March, we will love it, but not now. We're going to start to learn like this, all right? Let me give you, I want to talk about some fundamental facts, but then let me give you some historical facts here. These are historical facts. This is things that actually happened. This thing I'm talking about here had a name in the 80s. It was called particle economics. Why? Because I gave you a very simple version of this, but this, as you can imagine, in real financial situations, you don't have a stock that has two values. It has many, many values, and it's not just between today and tomorrow. It's many, so things are more complicated, but it's essentially this. And what happened is, in the 80s, universities, like I did my PhD in the 80s. I did my PhD in mathematics, and a lot of my friends were doing their PhD in physics. There was a lot of particle physics. Particle physics in the 80s was the funnest thing to do. So cool. It was fantastic. But what happened is many of those people who studied these wonderful physics, that did PhDs on quarks and particles, and it was fantastic, they couldn't get jobs because you couldn't get jobs as physicists. There were not enough jobs for all the physicists that were doing all those wonderful theories. So they ended up working in Wall Street in New York for Goldman Sachs. And these are people that went there with a very, very good baggage, very good equipment to do very sophisticated quantitative calculations. And in the 80s, people that were doing finance, they couldn't solve equations. They didn't understand things like that. So these are the people that, and now I'm paraphrasing, this is a metaphor. These are people that essentially their job was to realize who's willing to pay 50 cents for a game that they understood was 33 cents. And what do? If someone is willing to pay 50 cents and they know it's 33 cents, oh, they're very happy to sell it to you for 50 cents. Maybe they sell it to you for 49 cents and you think that they're giving you a favor. Right? And they make money guaranteed. And this was what finance became in the 80s. No one understood what they were doing, so they called it particle economics, because they were all particle physicists. Understand? That was a long time ago. But this thing was so relevant that it actually changed the financial sector. It changed the financial sector in a fundamental way. And that was perhaps the reason that this course exists, because this opened up for people to use mathematics, as we will see today and next week and the week after that, to enter the financial markets and do things. Okay, I'll tell you more stories about what happened. These were fantastic times. But let me stick to to the game that we have here. Oh, by the way, we're going to play this game in one way or another for the rest of this course. I will call it the 33-cent game, and it's going to show up in different ways all the time. All the time. And my advice to you is, whenever you are in a financial situation and you don't know what to do, try to find the 33-cent game somewhere, and then you'll have a clue. It's almost everywhere. We will see. Okay. Now, the first thing that we should realize is, what is with these 50 cents? Sorry, what's with this 50% probability that the stock goes up and down? You already mentioned that it misprices the stock, so we're not too surprised that it misprices the option, but we didn't use that anywhere, right? I told you the price is 33 cents by constructing a replicating portfolio. The probability of what the future values was never used. And in fact, it's not needed. And I gave it to you, not to mislead you, but perhaps to show you that sometimes you have data that actually you should not use. And that's one example. We're going to do this all the time, okay? But there's one thing that we need, and what we need is, and we used only implicitly, is the fact that none of the two events that I gave you should have probability 0. If one of them has probability 0, the argument I just gave you here, actually you will see it breaks down. I'm not going to get into that. The replicating portfolio has exactly the same characteristics as the replicating portfolios of last week. Last week, we were replicating futures contracts, we were replicating forward contracts on bonds, and this and that. Today, we're doing options, but it's exactly the same. The concept of a replicating portfolio is that it replaces our game, eliminating the things that we don't know, which is exactly what we did last week. And you can probably realize if you think about that for 2 seconds, that we can find the replicating portfolio by solving a system of linear equations. It was very easy to find the replicating portfolio for my forward stock transaction. Remember, it was very easy. I just realized, I borrow money, I buy the stock, and I wait. I didn't have to solve any equation. We had to solve one very simple equation to find the forward value of a bond. The equation was a linear equation, one variable, one equation, linear. The answer was this divided by that. Today, for this, it's also a linear equation, but you have 2 equations with 2 unknowns. So we've jumped from dimension 1 to dimension 2. That's all we have done from last week. Let me talk about replicating portfolios then. That's my second episode. Are we good? Everything is clear? Yes? We're all together? No one has been left behind? Yes? Are you sure? Anybody? People who arrive late? I need everybody to be in the group, okay? Yes.
So, regarding that, the previous example. So
Yes.
If the option is like priced at a third of a dollar, but it's still like 50-50 chance of paying out the $1 or like 0, then wouldn't the person buying the option be like winning in the long term? Like gambler be winning?
Okay. No. The one thing about finance is finance does not allow for repeated experiments. Okay, and this actually changes the way we do finance. In science, there is the concept of repeatability. You do something and you do it again and then the result will always be the same. In finance, we don't have that. In the game with you, we have that because flipping a coin is a physical experiment. And we know that we can replicate that for 1,000,000 times. But this stock is going to do that movement once. And we can't, so the argument that will happen if this happens 1,000,000 times doesn't apply in finance, because we're no longer dealing with a repeatable experiment. Experimentation in finance does not exist, which is, by the way, one of the reasons that finance is so hard. Okay, but these are very good points, and these considerations will help us shape how we think about what we do, how we think about finance. Okay, so let me get a little bit back into the same game. We already know the answers are 33 cents. That's the game we're playing, and I'm going to now bring in some consideration. I'm going to climb to the next hill. What happens if interest rates are not 0? So I'm just kind of going to borrow money from you, but say, oh, wait a minute, you have to pay me 10%. What happens? Is my argument, my replicating portfolio, does it somehow disappear, vanish? No, it just changes the price. So we're going to think about what we do in a slightly different way. We're going to think about borrowing as issuing a bond, which is what borrowing is. We already learned that. So if interest rates are not 0, or we assume some cost of borrowing, then we're going to think about the replicating portfolio in a more financial way, which is as follows. I'm going to look at my stock, goes up and goes down, but then I'm going to think of the bond. The bond is also a security. Yes? It's a security, and I'm going to do something that looks very silly, but it's going to help us build a very nice framework. I'm going to say, let me think of the bond as a security. I pay something for it now, and it gives me $1 in the future. So look what silly thing I'm going to do. I want to do a tree of prices for the bond just as if it was the stock. If the stock goes up to $2, the bond pays you $1. And the stock goes down to 50 cents, the bond pays you $1. Okay? So we can use the same tree building for the bond. And what is the price of the bond now? Well, it depends how much Muskan wants to charge me. I'll call it B. And B has built into it the cost of borrowing or interest rates, exactly as we saw last week. So what I'm going to do now is I'm going to rebuild my game in a slightly more sophisticated way by replicating the game with a replicating portfolio and then seeing what the cost of that is. And what I'm going to do is I'm going to pose the question, how many stocks and how many bonds should I have in my portfolio so that it matches the outcome of the game? So now we're not using hindsight, that I know that the price is a third and then you give me 33 cents and then I know exactly how much to borrow. We know nothing now. But we set up the equations that will tell us what we have to do, like that. I call A the number of stocks I should buy and B the number of bonds I should buy or sell. If I buy, A will be negative. If I sell, B or B, A will be negative. Okay? So these are the equations that A and B should satisfy if I want the replicating portfolio to replicate my game. I buy A stocks and B bonds. If A goes to $2, then my portfolio will be worth 2A plus B, because B is worth $1 whether the stock goes up or down. So in the first case, in the up branch, my replicating portfolio of A stocks and B bonds will be worth $1. And in the down branch, when the stock halves in price, the value of my replicating portfolio is A over 2 plus B, and that has to be 0. And that, if A and B satisfy that property, then I replicate the game that I'm playing with Kira. Yes? This is becoming elementary school math now. Which is good. Now we're in control. Yes? You know how to solve that, right? So then you know how to price, and you know how to build a replicating portfolio. We know everything. We are in control. And that's how we get the price. So if I have to introduce the cost of borrowing, I don't care, because that's the same as introducing the value of a bond, which is no longer $1, it'll be something else. So I can do my financial adjustments by taking into account the bonds and the stocks that go into my replicating portfolio. And doesn't matter what the interest rates are, I will always get an answer. And it's the right answer because it matches what we want. So if interest rates are 0, the value is a third. But if interest rates are different, for example, 10% or 11%, then the value will be a little bit higher. That's it. Yes? So now it looks like we can price these types of options when interest rates are not 0. Good. So the third hill I want to climb now, we seem to be in control, right? Yes, we're all in control? Yes, this is becoming easy, maybe even boring by now. Yes? But it's easy, yes? Okay, so in that case, imagine I go back to the beginning of class, and I'm going to give you the same question. I don't play with Henry anymore, I just play with Kira, okay? And I say, I have a strange coin with me. This is a coin that has a third of a chance of giving me heads and 2/3 of a chance of giving me tails. Weird coin. But I have it. It's a magical, it's the Hogwarts coin. Yes? And then I play the same game. If heads shows, I give you $1, and if tails show, I give you nothing. And I ask you, how much do you pay? then what do you say? 33 cents. You don't think about that, right? And they say, well, you're right. And then you think you know option pricing because you get the right price. Right? Okay, but now we know better, right? It was very important that I gave you the wrong probabilities. So you can see the difference between the right and the wrong price. Then you would not learn anything. If I give you the answer and you don't make a mistake, you don't learn anything. Footnote. That is how very often math finance is taught. They give you the right answer, and you say, yeah, sure, of course, that's the right answer. And then you realize that there's many, many ways of getting the wrong answer. And guess what? These are the ones that you're going to get for the rest of your life. Okay, so here we start with the wrong answer. But now we see, oh, wait a minute, there could be a way to get the right answer not knowing what you're doing. But I already told you, when you look at something that is an invariant, there's something special there. And where's the invariant here? The invariant here is that you get the right answer with the wrong algorithm. Right? So maybe there's something interesting here. Actually, and there is something interesting because suddenly with the 1/3, 2/3 probability, what you said about the stock, actually, the stock is not priced incorrectly now. The stock is priced correctly. So maybe we could hypothesize that if the stock is priced correctly, the option is priced correctly. Of course, we know the price of the option because we know the replicating portfolio, and we know this is actually true. So this measure is special. Not only it prices the option, it prices the stock too. The one theorem I will prove to you in this course proves that there are certain probabilities that price everything with the wrong algorithm. They're special. So we don't want to just dismiss them. We give them a name. We call them risk-neutral probabilities. Let's not care today why they're called risk-neutral. But that's just the name we're going to use. It's the probability that prices the game correctly with the wrong methodology. And why do I say it's the wrong methodology? Because it uses probabilities. We should not use probabilities. Do you understand what I'm saying? Now, this is talking about mental construction. This is 100% of a mental construction, right? Not only we are creating the probability, we do it so that it fits something which is the price of an option which we don't even observe in the market, but it prices the stocks. Okay? So with that, what we have is we can price the option correctly. And in this case, not only 1/3 is the right price because we can replicate, it's the right price because it matches the game that we're playing from a probabilistic perspective. And we can argue this in different ways. I charge you, I borrow, and I buy my portfolio. I replicate the option. Again, I'm assuming 0 interest rates for the sake of this. And the advantage of this diagram with respect to the previous one that we had earlier is that not only the financial game is consistent, of course it is, the probabilistic one is consistent too. Everything that you have in every one of those very simple trees, it's only 2 branches, is priced correctly from the probability perspective. Both the bond and the stock and the option are priced correctly. Special. So we give it a name. We call it the risk-neutral probability that leads to arbitrage-free prices always. There's now some considerations. Do they always exist and this and that? Okay, there's a lot to say about that. We're not going to get worried about that. But we've developed a very important terminology, which is that with risk-neutral probabilities, the objects that you have in the financial markets, they're all priced with probabilities. You don't have to do the replicating portfolio. This is a great advantage. Sometimes the replicating portfolio takes a lot of effort
computational power, equations, this and that. The risk-neutral probabilities, once you do them once, they're good all the time. You can reuse them as much as you want. Computationally, they are very, very efficient. We're going to see that. Probably not today, probably next week. We're going to see how risk-neutral probabilities will make some of our algorithms faster. But I don't care for that right now. I want you to understand that we can bring these probabilities that gives the right price as a special consideration. And then, at least from a mental perspective, we've achieved something, okay? There's much more to say about this. We're going to spend a good amount of time, and not only with the risk-neutral measure, but also with some of its related objects that help us price things. So I'm going to just, the risk-neutral measure contains, in a certain way, it's going to contain in it also ways to understand the structure of time. I talked about the price of time last week. That will be there. The risk-neutral measure is going to contain lots of other interesting things in it. So let me just, we'll come back to that. We're going to come to this. And what I want to do now is I want to talk about something which is called incomplete markets. And for that, it's my fourth hill. I want to change my game a little bit. And now I'm going to change my game in a very fundamental way. Because I'm going to assume I'm converging now towards reality. Okay, I told you stocks typically don't have only two possible values tomorrow. So what if they have three? Let's go from 2 to 3. I have a stock that is $1 today, and it can go to $2 to 50 cents, or stay at $1 tomorrow. And we play the same game. Okay, so I play. This is the stock value in the future, and Kira, I'm going to play with you. Same thing. I give you $1 if it goes up, and I give you nothing if it stays flat or goes down. How much do you pay? So we've learned a lot, right? And we felt powerful. How much do we pay?
It should still be the 1/3.
1/3? 1/3?
The outcome's like the same.
Hmm?
Because the outcome's like the same.
Okay, so let me stay with his answer. So I want to understand. You say you pay 1/3 because?
So like, as a person like buying the option,
Right.
Your payoff's the exact same as like the one where like you have like.
Okay, great. But again, we're financiers, right? We're no gamblers, right? Okay, so we're financiers. Great. So, Kira, see, you pay me 33 cents, right? He says that I should charge you 33 cents. Okay, so I'm going to do that. You gave me your 33 cents. They're right here. What do I do now?
So you borrowed the 33.
I borrow, how much?
Sorry, so I paid you 33 cents.
Oh, you want to play with me? So I don't play with Kira. I play with you?
Wait.
So you want? Sorry, I have to play with him now.
I'm confused.
No.
Sorry.
It's okay. No, I'm happy to trade with you. You give me.
Yeah.
He thinks he can make money for free. That's why. That's why. Okay. Good. I play with you. You gave me 33 cents. Great. Okay.
33 cents.
And now what do I do? Help me out.
So
Actually, you know what? No. I play with you, but you pay me. So now I give you 33 cents. What do you do?
Right. So I'll borrow.
Muskan is still happy to lend you money. She's in the business of lending, so she's happy to lend you money. So you borrow, yes.
So yeah, I'll borrow the.
Everybody should follow this, okay? Because we're doing a trade. Yes. You're going to borrow from Muskan. How much? She's ready.
33 cents.
33 cents. Yes? Yes.
Yeah. And then I'll buy the.
2/3 of the stock, maybe?
Yeah. 2/3
Okay.
of the
You buy
stock.
2/3 of. Great. So he buys 2/3 of the stock. Round of applause. Great. Now what? Now you wait.
Yeah.
Okay. The stock goes up to $1.
Stock goes.
The stock goes up to $2. You have exactly $1.33, right? So give her the $1, give Muskan the 33 cents, and then you break even, right? Yes. The stock goes down, and you have exactly
a third of a dollar, right? So you don't have to give Kirat anything. You return the loan to Muskan. And if the stock goes at stays flat at a dollar, no, finish. Don't say, finish. If the stock stays flat at a dollar, then what?
I'll pocket the rest.
Exactly. That's why you wanted to pay 33 cents. I knew he wanted to make profit. I told you it's not allowed. For a month, that is not allowed. You understand? Do you understand what I'm saying? Right? He will make how much money for free? He's going to make 33 cents for free. Sorry, that's not allowed. For a month. After a month, yes, sure, as much money as you want. You see? You do that trade, it almost works, except in the new scenario which is given to us, you make money for free. You of all people make money for free. Of course you're happy to do that. But I'm telling you, no, that is not an arbitrage-free price. Hirat could have been very happy to play with you. Perhaps, I don't know. Not me, no. Because I know you're going to make money for free. You have arbitrage. Yes? Okay, hold on. You see, you're suggesting we have to change something, right? Your question, you're asking me if we should change the probability or the option. And what I want to, why should we change anything? Why? Wait, okay, yeah. See, I like very much what you're asking, because you're making an assumption. You're making an assumption that there is a price, when in fact what's happening is that there is no price. Now, sorry, I know where your minds are going. I say, wait a minute, what do you mean there's no price? I mean, someone could do this in a financial market, and then what's going to happen? You can't say that you don't trade. Of course you trade, and of course someone is going to make money for free, of course. That's what happens in financial markets. That is how this metaphor continues. But that's not why I'm here today. I'm here today to teach you about option pricing. And my duty is to tell you that this situation is one in which the price does not exist. So you want to trade, go ahead and trade. You don't need me for that. But I want you to understand that in this case, there is no way to trade in an arbitrage-free manner. Something is going on, and I want to tell you what's going on. And I want to tell you how we can solve it. But for that, we need to change the market information we have. We don't have enough information, or we don't have enough something. We're missing something. That's what's happening. We're missing something. And I want to tell you what it is that we're missing. That's going to keep me busy for an hour. But when we get out of that, Eric, I know you want to talk to me. But when we get out of that, when we know what we're missing and we know what to do about that, now we're going to be so powerful, because then we can price almost everything. You will see. This is the key. This is the key to understanding how the 33-cent game that made us feel very powerful for a few minutes is still the key to understand situations which are very, very complicated, okay? And you have to write crazy Python code to do this and do that, and you can price on it. But this is the key. This is the example that will tell us if we have to go this way or that way. And that's what I want to tell you in about the next hour. Now, Eric, what do you want to ask me?
I don't have a question. Just want to make a comment that the reason why there's no price is because we have three equations.
Well, okay, so there's a so then, well, in fact, I think you've seen my lectures, so you know what I'm talking about. So let me reflect on this before we make advances, before we move forward. Let's reflect on this. Let's see how we have seen this before. And you have seen this before, probably in high school, when you did high school math. That's my guess, okay? So let me, because then that analogy is going to help us. So in this case, we cannot find a replicating portfolio. And in fact, as we just saw, it could easily lead to arbitrage-free pricing. In fact, that's the only way we can do that. The analogy here is that, is the following, is what Eric was saying. We've already seen how we build a replicating portfolio, and the replicating portfolio was the solution of a system of equations, two unknowns and two equations, right? Okay, why did we have two unknowns? Because we had two securities, the bond and the stock.
Why did we have two equations? Because we had two scenarios. Here we have three scenarios and two equations. So if you are going to find the replicating portfolio, you're going to have three equations with two unknowns. You've been there before. What happens when you have three equations and two unknowns? What happens? You have to speak really loud. I'm so far from you.
You get like no solution.
Most of the time you have no solution. So what that means in our context is that most of the time, like 100% of the time, you're going to have no replicating portfolio. And if you have no replicating portfolio, that means that you don't have an arbitrage-free price. So this situation where you have more scenarios than stocks, than securities, they could be bonds, this situation leads to zero solutions, no replicating portfolios, no price. You can still trade, go ahead. And you want to trade with him, he's going to make money sometimes, for sure, for free. And that's great. But this is not the theory we want to build here, okay? So in this case, we don't have a unique price, and there's ways to do it. But now, my job after this is to tell you how we can address this. There's two different ways to address this. Two different ways. With capital asset pricing theory or with dynamic trading strategies. And I want to tell you both. But I think for that, and I'm going to try to explain to you how markets work, how liquidity providers give us one or the other. But I think for that, I think it's a good idea to take a break now, right? We take a 10-minute break, relax your brain a little bit, and when we come back, we're going to climb a fairly steep hill, okay? When we come back, 10 minutes. So I had a very good question from you. A very good meaning a very honest question. He told me that he doesn't understand replicating portfolios, basically, right? Okay, I'm exaggerating. And I said, well, let me make sure that you understand in front of everybody, because I suspect he's not the only one. So if you understand and it's all clear, sorry, you're going to be bored for a few minutes, but it's very important that everybody understand the concept of a replicating portfolio. And I'm going to tell you a story. That is perhaps a good preamble to understand replicating portfolios. The story, I forgot the exact year. It was in the 80s, early 80s. And there were two players. There was a, you probably know Procter & Gamble. Have you heard of that firm, Procter & Gamble? The detergent you use is probably sold by them. Okay, it's a very large consumer product company, very, very big. And there was a bank that you probably don't know. The name of the bank was Bankers Trust. It was a big bank in New York. Eventually, it was bought, I think, by Citibank, and you don't know the brand anymore, but back then it was a very, very big bank. And Bankers Trust was in the business of selling swaps. Swaps are financial derivatives that they are related to interest rate. I'm not interested in explaining what a swap is today. We will do swaps, a lot of swaps, in the future. But this was a swap that is sold to Procter & Gamble, where they basically said, if this happens, I pay you, and if this happens, you pay me. Just like today. And Procter & Gamble looked at that and said, well, looks good. That's the price, looks reasonable, let's do it. In a swap, you don't actually pay up front. What happens is that you pay sometimes you receive, sometimes you pay, right? And after a while, Procter & Gamble saw how strange. Another quarter went by, and I have to make a payment again. It looks like I will never get paid. So they did a bit of research, and they saw that, yes, exactly. It was very unlikely that they will ever get paid. They will systematically pay Bankers Trust. It was a swap that was structured in such a way that it was very asymmetric. So Procter & Gamble did some research, and they
I guess they hired someone, and then they saw that this swap was in fact very lopsided. It's as if, back to our game, they would charge 50 cents for the game. If you understand the metaphor now, right? And so eventually there were some tapes, because banks, when they do trades, they have to record the conversations with the client. It's part of the law, you have to record that. And apparently there were some recordings that included part of the conversation before the client joined. And then the Procter & Gamble people, the Bankers Trust people talking to each other, they explained how they were going to rip off their client. And they came up with, people in Wall Street, they then referred to the rip-off fee. And it was settled out of court. It was just too embarrassing, and they paid and this and that. But there was one shareholder in Procter & Gamble who was extremely upset. I said, that settlement out of court does not satisfy me. So I think it was a he. So he went on his own and sued Bankers Trust, not for that swap. He said this type of derivatives that they are selling is gambling. And gambling, as you know, is illegal in the state of New York. It's legal in Nevada, but it's illegal in the state of New York. What do you think happened? Do you think it was dismissed? No. All the securities lawyers of all the banks were terrified, because if that, for some reason, wins, then derivative trading will be illegal and their business goes up in smoke. What do you think the defense was? The example we saw today. So, a Bankers Trust, I'm exaggerating a little bit. So Bankers Trust, in its defense, said, this is not gambling. This is a financial transaction, the outcome of which we already know. So the replicating portfolio, you understand? The replicating portfolio could be used as a defense against being accused of gambling, which in fact we have done today. It's not gambling, right? So when you have a financial situation where there's something you don't know, we've seen that already. Remember, the forward stock transaction, remember that? At what price will I sell you Apple stock a year from now? Does not mean I know the price of Apple stock a year. No one knows that. But I don't need to know that, because I could borrow money, buy the stock, and give it to you in a year. And that was the replicating portfolio of my forward stock transaction. We saw another example also last week, which is I can agree to sell you a bond that doesn't exist in a year at a price that I already know. And I can do that so I don't make or lose any money. And what was that? That was, I bought some bonds with some maturity and I sold some bonds with some other maturity in such a proportion that the cash flows from those two bonds give me exactly what I have to pay over time. We saw that last week. And today we're seeing that again in a situation where we don't know what's going to happen. We saw that in a situation where we're dealing with a lot of uncertainty, because the stock would go up or down and we don't know. So in that case, what I did is I make a commitment, in this case to my client. So Kirat, I made a commitment, I'm going to give her $1 if this happens and nothing if it goes down. Think of it as an insurance policy, right? Maybe the asset I'm doing my trade with is, for example, the price of kerosene and your Air Canada. If it goes up, oh my God, my operations are going to cost me a lot of money, so oh, no worry, I give you money. Oh, kerosene is very cheap, I don't need anything, I'm already saving, no, that's great, I don't have to give you anything. Right? And for that, like in an insurance premium, I charge you something. So it may look to everybody that I am taking risk. The reality is I'm not taking risk, because when you pay me, Air Canada, you pay me something for the price of fuel protection. I take that, I go to the bank, Muscana, I borrow money, and I buy some futures on fuel,
and then that's it. And when it's time to deliver, I said, oh, it's time to deliver. Wait, I have my replicating portfolio, I unwind it, and that gives me the cash that I need to pay her. So whenever you have a contract, don't forget, what we call the game here is a financial transaction. And a financial transaction is a contract. Think of a contract of 25 pages with lots of conditions and this and that, right? And clauses. It's a contract. The contract uses something which is called an underline. An underline is because this is a contingent claim. If the price of this is that, then this happens. If the price of this triggers something else, right? It's a contract. So when I have that contract, sometimes I can build a financial portfolio with this and that portfolio will match exactly the cash flows that arise from that contract. That's a replicating portfolio. Okay? So to understand a replicating portfolio, you need to understand two things. You need to understand that it replicates a financial transaction, which is a contract, and it could be very simple or it could be incredibly complicated. And the financial portfolio that replicates that, it also could be very simple or very incredibly complicated. I'll give you another example. I guess, who has a mortgage here? I have a mortgage. Anybody has a mortgage? No, you're too young for that. Well, but you know what a mortgage is, yes? What is a mortgage? Mortgage is a financial transaction. A mortgage is essentially, they lend you money, yes, but it's essentially an option like the one we saw here today. Why? Because if you get a fixed rate mortgage, when rates go up, you don't have to pay more. So think of a mortgage as a financial transaction. It's an obligation the bank has with you that they're going to lend money, and if rates go up, it's okay. They're going to charge you the same. So you could think that if rates go up, the banks will lose money because they sold you those mortgages, right? It's a form of, it's a loan, but it's a loan with optionality built into it. And this is the optionality that I care about now. Because the optionality is that it's a loan at a fixed rate. If the price of money goes up, you pay the same. So it may look like a bank is taking risks when they do that, when in reality what they do is exactly what we're doing here today, exactly the same, right? You can think that if rates go up, I pay you money. They don't pay you money, but they charge you the same, which is the same as saying that I pay you money, I'll pay you the difference. So a mortgage would be like a string of options like the one we discussed here today, one per month. That's a way to think about a mortgage. You understand that? Right? Because every time a mortgage gives you protection, and every month, then it looks like the instrument we defined here today. So that should have a replicating portfolio. And the replicating portfolio is what you can imagine. It's a monthly string of cash flows, very similar to the replicating portfolio we did with A's and B's, bonds and stocks today. Very similar. Except they're not stocks, they're bonds. So bonds and bonds. Bonds to borrow short term and bonds to buy long term, because that's what a mortgage is. I don't need you to know the details, but you understand the philosophy that if I want to hedge a mortgage, then I want to buy bonds of different durations, some which I do for borrowing, treasury, and others that I do for protection. And those cash flows should match the payments that I get from the mortgage, right? And that will eliminate the risk. So every time you have a financial instrument, think of it as a 25-page contract. I will have a financial transaction without pages. No, it's just a financial transaction. I buy this, I buy that. It's like an Excel spreadsheet with instrument and price I pay. That's my replicating portfolio. And it'll be, so that you know what a portfolio is. So a portfolio is replicating if every cash flow in my contract is replicated with the cash flows in my Excel spreadsheet. Does that answer your question? And you can have very complicated product with very complicated spreadsheets
describing what the replicating portfolio is. We did the easiest today. I'm about to do something a bit more complicated. And my promise to you is that if we understand what we're talking about today, you will be very powerful at constructing replicating portfolios for really anything. We just need to understand the cash flows, like we did last week with the forward bond transaction. Ready for that? Okay, so what we have done, are you good? Yes? Yes. So what we have done today is I started in the simplest possible way. Two securities, bond and stock. Two possible scenarios. The linear algebra works. We can replicate anything. And then I hit you with a situation that looks very worrisome, because now I have three scenarios, two instruments, and oh my God, what do? We don't have a unique solution. And in fact, Henry here proved to us that in that situation, you can make money for free, which is a no-no for a month. Okay? We're good? All right, so what do we do? So there's two things that we can do. I'm going to look at it from the following perspective. Imagine I have my stock, three scenarios, a third, a third, a third. I don't want to be very creative when it comes to that. We already know that the probabilities don't matter anyway. Right? And I have my bond that gives me $1 with a third, right? Same thing. And what I want to do is I want to understand what I can do in this situation. If I have this option and I want to price it, I would like to find a replicating portfolio. And the answer is that I can't. And I have another one here. It's a different one where if I pay you in this case, if the stock drops in price, I can't do that either, right? And I can come up with many, many different options, neither of which I can price. I'm going to call these I'm going to introduce two options. You will see why. I'm going to introduce two options, neither of which we can do. I'm going to call this one O1, and I'm going to call this one O2. In the first one, you get paid when the stock goes up. By the way, you may know that's a call option with a strike 1. The strike price is 1. You may know what I'm talking about. This one is a put option where you get paid when the stock price goes down. And the strike price in this will be 0.3. You get paid everything below 0.3. Doesn't matter. In one you get paid when it goes up, in the other one you get paid when it goes down. I can't price either of them. But there's two ways to resolve the incompleteness of the market. There's two ways. The first one is, imagine I introduce a trading period before maturity. Imagine that between today and tomorrow, let's say the option expires tomorrow, I can trade in a few hours. Okay? Or if this is for a year, imagine I can trade in 6 months. So I introduce a new time element in that. And then, if I do that, this is very interesting. Let me analyze that. I gave you one here. I said my stock is $1, but before it goes to $2, it's going to go through an intermediate stage, which is at $1.50. And from $1.50, it can continue its path to $2, or it can come down to $1. And if it goes down to before it goes all the way down to 50 cents, it has another intermediate stage, which is it stops at 75 cents. And from there, it can rise up back to $1 or continue to fall to 50 cents. That's one way to resolve the incompleteness, introducing an intermediate trading time. Are we good? So this is a dynamic situation. We've reduced or we resolve the incompleteness by introducing a time variable, by reducing the incompleteness in time. The other one, as you can imagine, is reducing the completeness in price space, in dollars. Okay? But let me stick with this for a little bit, because in this case, if I have a bond, I'm assuming 0 interest rates for simplicity. My bond has exactly the same price path as the stock, and the value is 111 in every one of those notes because there are no interest rates. Right? That changes my picture, and in a way that, by the way, we'll become masters at this. This will be very, very easy to deal with. This is the simplest situation, the simplest way to deal with this. And I can advance you that if we can introduce one intermediate time step, I can introduce 1,000,000 intermediate time steps. And then from there, we will be able to go to continuous time finance and then do wonderful things. You can trade every second. That's how we will end up trading every second. But we're going to go from 1 period to 2 periods. That's all we're going to do today. And how do we do that? Note one thing. This is the key. Okay. Look at the yellow triangle that I have there. What is the yellow triangle telling me? I have a stock that is worth $1.50. Only the yellow triangle. Don't look outside of the yellow triangle. I have a stock which is $1.50 that can go to $2 or to $1. And I have a bond that is $1, no interest rates. It's always going to be $1. We've learned that in the yellow triangle, we can price anything. I don't care. Give me whatever game you want. I can price it because I can solve that system of equations of 2 by 2. Right? So we know how to do that. And then if I go to my green triangle, oh, what happened? Sorry. If I go to my green triangle, that I can do too. Because in the green triangle, I have a stock which is 75 cents, and it can go up to $1 or down to 50 cents. And I have my bond, 0 interest rate security. So I can price everything there also. That means that if I play a game, or if I have an option of strike 1, which gives me $1 when it goes up and nothing when it goes down, I can go to the yellow triangle. I'm trying to go back to the yellow triangle. I can go to the yellow triangle and I can price it. I can price it either by finding the replicating portfolio or with a risk neutral measure, as we did earlier, right? Anybody has any doubt that you could do this? If I give you a minute and a half, you can do it. Oh, I don't know. Are you? You're looking at me as if you don't know what I'm talking about. I'm going to do it for you, but that is not going to help you. I need you to be sure you could do it.
I'm just a little bit confused.
Yes.
About how you could manage the replicating portfolio this way, or this is how the option dealer would trade?
Both. Okay. You know what? I think I'm gonna. I feel the urge of asking you to calculate that replicating portfolio. I'm not going to do it. I'm going to do this one. I can ask you to calculate the replicating portfolio and the price for the option in the green triangle. Let's try that. What is the game? What is the option corresponding for the green triangle? Do you want to trade with me? Okay. Good. What is, again, we had an option that gives you $1 when it goes up and nothing when the stock stays constant or goes down, right? Yes, okay, good. So let's deal with the green triangle. How much does the option pay in the green triangle? Pay. No, that's the stock. The stock is $1 or 0.5, right? The numbers I have there on the screen are the stock prices. The option was, I remind you, is not written here for a reason, because I'm solving this whole thing for you in the next slide. So the option, there were two options, O1 and O2, remember? O1 was 100, and O2 was 0.2. I remind you. Okay, so O1, let's do O1. 100, right? Good. So I have a stock that is worth 75 cents. It can go up to $1, down to 50 cents. And if the stock goes up to $1, the option pays you 0. And if it goes down, it pays you 0. Okay, what's the price of the option? 0. Round of applause. Fantastic, you got it. Well, let's do it here. And the replicating portfolio is nothing, because I replicate nothing, right? I don't buy a bond, this is 0 and 0. I don't buy a stock, I don't buy a bond, I do nothing. That's the simplest thing, right? But if I was going to do this on the yellow triangle, which requires a calculation, what would that be? Something else. Let me go to option O2. O2. In O2, if the stock goes up to $1, you get nothing. And if it goes down to 50 cents, you get paid 0.2. We're going to buy A units of the stock and B bonds, right? That requires a calculation. So we have two equations for A and for B. What is the first equation for A and B in the first scenario? Well, A, the stock is 1, so it's 1A. Are you following what I'm doing? All of this will be shown to you in the next step, but I prefer that you do it on your own. So follow me. It's A, because the stock is 1, right? See that? I'm doing it here, right here, right? The stock is 1. If my replicating portfolio is A stocks and B bonds, the value of my replicating portfolio will be A plus B. And when the stock goes down, it'll be A over 2 plus B plus 1, say 0 interest rates. Right? So A plus B equals 0. A divided by 2 plus B equals 0.2. You know enough linear algebra to solve that, right? Whatever the solution, that's the replicating portfolio. Yes?
Why is it over 2 if in the green triangle the stock decreases by like 0.75 to 0.5?
No. I'm looking at the value. My replicating portfolio is A stocks and B bonds, yes? Okay. If at maturity, A stocks will be worth
That stocks 50 cents.
No. Here.
$1.
$1. So A, right? My replicating portfolio will be worth A plus the bond, which is B. Right? So that is equal to 0. And A divided by 2, because my stock is a half, right? Plus B equals 0.2. That's the payoff of O2, right? I know what you're thinking. You're thinking percentages and this and that. No, too complicated. Forget percentages. Let's just look at dollars, right? That will give me A and B. Can anybody give me the answer to that? A and B? I don't know.
B is 0.4 and A is minus 0.
Is?
Minus 0.
Okay, so I'm going to, I'm not going to go, I'm going to lend you money now, okay? How much money am I lending her? 0.4. And I'm shorting, how much? 40% of a stock, right? When I short 40% of a stock, I get money. How much money do I get for that? The stock is 75 cents, right? So I get 75 cents times 0.4, which is how much? Okay, I don't multiply in public, okay? It's 0.4. It has to be 0.4 because that's what I'm borrowing, right? So that's my replicating portfolio. No, it's not 0.4. How much was B? 0.4. and A was minus 0.4?
Yeah. Because it has to.
Oh, no, sure. Of course. Because then that gives me the option price. So the option price will be the difference, right? Okay, now please help me. I don't like to multiply in public. Okay, what's the answer? What's the value of the replicating portfolio at this node? What's the value of the replicating portfolio at that node? Because that's the value of the option price.
Would it be like 30 cents?
30 cents? I believe 30 cents. So that means that my option will be worth 30 cents. That's O2, right? Do you understand what I'm saying? No, now I got you lost. Maybe I continue with what I was planning to. Okay, I'm trying to answer your question. I don't want to lose anybody. That's my objective. No, we'll finish this. We'll finish this. Some people are following me, so I want to finish the calculation. So Gabriel, you help me out.
The value of the option is the stock price.
It is the value of the replicating portfolio.
At the moment, like
At this point, yes.
Yeah.
So it's
I think it's 0.1.
0.1. So he thinks it's 0.1, you think it's 0.4.
The stock portion is the 0. What's the negative 0.3? So
Okay, I believe 0.1, it has to be less than 0.2. So I believe 0.1. So that means that the value of my option here is 0.1. 0.1. O2, option O2 is 0.1, and you did it yourself, right? By the way, what is the value of the option O2 up here? 0. You see that? Because no matter what the stock does, it's going to give me 0. Right? And do you understand that? Behind you, I don't know your name. Do you understand that? What's your name? Arvin. Okay. You understand that? The value of option O2 here is 0. And here is 0.1 according to Gabriel, right? 0.1, 0. Are we good? Yes.
Why did we mention asset O2?
Why?
Why did we mention O2?
Oh, because I don't know. I was trying to answer his question. I'm giving an example. I could have done O1, but I decided to do O2. I don't know why. I know why. Because O2, O1, I have the answer coming up later. So
So the option price is the same as the price of the replicating portfolio.
it has to be the same. Because no one is making money. Right? The replicating portfolio, the option price, they need to be the same because no one is making money. If they're not the same, someone is making money. We don't like that for a month. No. Right? I don't know if I'm answering your question or if I'm giving you more.
I think I'm understanding like a bit better.
Okay. In fact, I'm going to continue because now I can go and do this rectangle for option O2. We can't because we've done already all the work. Because for option O2 now what I have is this. I have a stock that is worth $1 and it can be $1.50 if it goes up or 75 cents if it goes down. And I have a bond which is $1. And I have an option, I don't know the price, that when the stock goes up, it gives me how much? 0. And if it goes down, it gives me how much? 0.1. And we know how to do that. Again, so we solve another system of 2 by 2 equations with different A, different B, and I get my replicating portfolio for that option. Someone can solve the system of equations, you know how to do that, and that gives me the replicating portfolio now. And by the way, that gives me the option price now. And that's how you do it. If you don't understand what I'm saying, please ask me. I have this worked out coming up, but I wanted to be opportunistic. I don't miss the opportunity to answer a good question. So I had to answer now. I don't like to say, just wait, and then I'll tell you later. Because then you forget your question, and then I forget the answer. So.
Is the 1.5 and 0.75 they're arbitrary?
Okay, so for us, right now, yes. In 2 weeks, no. But for us, yes, they are arbitrary now. You could come up with a different number, and then you'll get a different answer. I'm not getting into how I determine those values. I'll get into that in 2 weeks, and that will be very, very important. Very, very important how we get these numbers. No, no. Okay? Is everybody with me? Everybody feels like you're not sure? I cannot lose anybody now. Are you sure? It doesn't cost anything to raise your hand. Okay. That's how we do it. That's how we do it. And we can do this with more trading days. We just need to write a slightly longer. No, actually the Python code will be the same, right? Because you're going to just do a for loop and then just, if you do it by hand, yes, it's longer. But if you're writing Python code, it's the same, right? And we could take this to infinitely trading sequences, and that leads to continuous term finance, and we're going to have a lot of fun dealing with that in a few weeks. But not now. No, no. We need to understand this very well. So that's one way to resolve it. But there's another way to resolve it. Imagine that someone, Henry here, says, wait a minute, for whatever reason, I like that option 01. And I am willing to offer $0.33 for that. What happens if now a new player comes into the market and says, no, 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 I give you the price for that 01? What happens? Conceptually, mentally, what happens is that if someone gives me a price for option 01, then what happens now? I have a universe of 3 securities, stock, bond, 01, and I have 3 scenarios. So now you can build replicating portfolios for anything. In particular, you can build a replicating portfolio for 02, for example. Henry will be called a liquidity provider. Said, hey, I give you the price for that. Great. As mathematicians, you're grateful because now your equation has a solution. As financiers, you couldn't care because you're not there to do math. But today we're here to do math, and that's why we're grateful that he's giving us liquidity so that I can have a nice, beautiful 3x3 system of equations. And that's how we're going to look at what we're doing from an algebra perspective, where solutions will be given by solutions of equations. And the more securities I have, the better answers I will get. And that is thanks to liquidity providers. Are you understanding what I'm talking about? That's how markets work, at this very simple level. I think you understand. Your faces tell me that you understand. But if I'm wrong, raise your hand immediately. Kira, are you understanding? Okay. So now we've climbed to a hill, and we see now 2 further hills. One hill, which is what's called the capital asset pricing model, and the other one, which is the dynamic asset pricing model. And which one do we do next? Let's not decide. Let's look at the landscape first, okay? Let me talk about the capital asset pricing model, which I will spend less time on to begin with. I will do that in 2 weeks, or actually next week, okay? The capital asset pricing model, what we will do for us is the following. We're going to be able to develop the following type of theory, inspired by your liquidity providing thing. If I have a universe of many, many securities, and for those of you who know enough math, we can even assume infinitely many securities. and a situation where I have many, many, many different scenarios. And for those of you who know enough math, infinitely many scenarios. I can assume that. And what I can do is I can develop a framework under which the measure will exist. Sorry, the price will exist, always. The dynamic asset pricing theory is the one where I am going to introduce trading times, and my replicating portfolio will be a function of time, which means I have a price, I have a portfolio now. You say, oops, the stocks moved, and I go and I change my replicating portfolio. And then I go to work tomorrow, I said, oh, I have to change it again. And oh, I have to change it again. And when my option matures, I have exactly what I need to pay Kirat and return my money to Muskan. That's the dynamic asset pricing model. And that's why people go to work. Because depending on what happened, you have to do this, you have to do that. Banks have mortgages. And we already went through the fact that mortgages are options. So, oh, rates went up, okay, I have to buy this. Oh, rates went down, oh, I have to buy that. And it's algorithmic in an idealized way. Right? We assume that no transaction costs, everybody works for free. I'm telling you, in the financial sector, no one works for free. But for a month, if people work for free, we have a framework to do these things, to price these securities, to price mortgages, to do things like that. Do you understand what I'm saying? In an idealized situation, framework, where everybody works for free, it looks like we know what to do. We're very close to that. And it's playing that 33-cent game over and over and over and over again. Every day, if your increment is daily, every second, if your increment is by the second. Understand? I want you to understand, okay? And this is how the Black-Scholes theory is built, because at some point we will see how we can take the limit when the increment of time goes to zero. And there's a very nice mathematical way of getting that answer, and that is the Black-Scholes theory, and blah, blah, and we'll talk about that. The capital asset pricing model is the one that expands the universe of securities, and we will see the context in which. We're going to do both in a very simple format. I'm not going to do the Kaplan model except in single period with finitely many scenarios and finitely many instruments. I give you hints if you want to know how it's done with infinitely many, but I will just do finite. And the dynamic asset pricing theory, I'm going to do it with 2 time steps. That's it. Because if you can do that, you can do 3, 4, 5. That's all I'm going to do. That's all I'm going to do. Okay? All right. Okay, let's see. I don't know if... I'm going to make some remarks about the dynamic asset pricing theory, just some remarks which have to do with the computational complexity of this. Very important. In fact, I will tell you one of the things that I am not going to do, and I'll tell you why. There's 2 ways of doing dynamic asset pricing theory, the Markovian and the non-Markovian way. I don't know if you know much about this, but you will learn here. I'm going to explain everything you need to know. The Markovian way is what we have seen here, where if a stock goes up and then down, or down and then up, goes to the same place. Okay? This is what's called a memory-less system. A non-Markovian is where going up and down and down and up not always give you to the same place, and history matters. That's the non-Markovian way. What's the problem? The problem is that in the first one, the Markovian way, we lack memory. We don't know. We're here. How did you get here? I don't know. That's the Markovian way. And I don't know because it doesn't matter. Whereas in the other one, in the non-Markovian one, we have full memory, and the trees that we have are what's called non-recombining trees, as opposed to the Markovian trees, which are recombining. Recombining means down and up, up and down and up is the same. Now, Let me ask you a very simple question. Imagine you do a non-Markovian tree where you're going to be trading every day for a year. How many nodes do you have? You can't store it in a reasonable hard drive. Your AWS bill will be very big. Right? Understand? You see that? Essentially 2 to the power 365. That's big. That's big. You don't do that. So non-Markovian is very expensive. How many nodes do you have in the Markovian tree? A few thousand. Your iPhone can store it, no problem. Yes? See that? So there are many reasons why you want to stay Markovian. Many, many reasons. That's just one. And in this course, we're going to stay Markovian. Nothing non-Markovian, okay? We don't need it. But I do tell you, some of you may have a non-Markovian life at some point. Good luck. Make sure you have very good budgets and lots of time. And very big and fast machines. Yes? But here I'm not doing anything non-Markovian. Okay, great. So I'm ready to tell you, we already did it here, but I'm now ready to explain to you the dynamic asset pricing theory, the multi-period pricing. I don't know if I should do a break or continue. I don't know. I think I'm going to continue. It's very close to the exercise we did. Okay, I'm going to try a little bit, and if I see it, I put. Okay. So this is my market information. Market information is where the stock goes and where the bond goes. Right? Market information. It's the same as before. I like to stay with the same so we don't have to. Great. And now I'm going to go very diligently through this, what's called backward propagation. We start at the end where everything is known and everything is disclosed, and I walk my way back to today. Backward propagation. It's interesting when neural networks became very popular, suddenly the term backward propagation changed. But we've always called this backward propagation. I guess backward propagation is very old. So we went through that already, and in fact we did one example. I have here the worked out example of the option, which is slightly different. It is a call option with strike 75 cents. And what is this? So I am now introducing a new term for the first time. I'm introducing the payout of the option as call options are written, which is the option will give me the difference between the stock price and 75 cents only when that number is positive. That's the meaning of that little plus sign underneath the bracket. So if the stock goes up to $2, it gives me $1.25, so it's different from 01 or 02. If the stock stays at $1, it still gives me 25 cents, and if it drops to 50 cents, it gives me nothing. That's my option. And we're going to price it. And I have the answer explicitly for you. I'm very happy we already did one, thanks to your question earlier, right? Now we're going to do the same thing, but properly explained with all the numbers there so that it looks deceivingly easy, but you already done it on your own, so you already know that this thing is. So when I go there, what I have is, that's my replicating portfolio. Okay, you know you have to do it by solving a system of 2 by 2, and you trust me that the answer is that. That means that the replicating portfolio is I hold one stock and I borrow 75 cents or 75 units of the bond, whatever that is worth, right? Yes? That's the replicating. You know how to solve the replicating portfolio, right? We did it now several times today. You know how to do this? Yes, right? Yes, you. Yes? So you're an expert on replicating portfolios now. Huh? I would go that far. I would go that far. You're an expert. You understand that, right? I mean, you don't. I know that you don't have your mental processor is not so fast to give you the answer like that with decimals, but you understand that you set up a 2x2 system of equations, you get that answer, right? You're an expert. Okay. And because of that, the value of my option at that node is 75 cents, because that's the stock is worth $1.50. Just plug it in there. The bond is 1. We assume no interest rates. The answer is 75 cents, right? You can multiply in public. I cannot multiply in public, but you can multiply in public, yes? So 75 cents, that's the value of the option there, right? And then I can go to my green triangle, and I can do the same. I changed the payout so I get a little bit of money even when the stock stays constant, so that I have a non-trivial answer here, and that's why I did it. But logically, this is perhaps more interesting than the previous one. And I see that the replicating portfolio, I still hold half a stock, and I borrow 25 cents, which makes the value of the replicating portfolio 12.5 cents. Therefore, the value of the option has to be 12.5 cents. Is this getting boring by now? You're experts at this now. Yes? Are you? Do you think you're an expert? Are you an expert? Are you an expert? No? What's not clear here?
Can you please explain that again?
Good. Okay, great. Thank you for that question. So you know that we can find replicating portfolios by solving a system of 2 equations and 2 unknowns, right?
Yeah.
Yes, we saw it earlier, and we did it in our head earlier, and now I have it here, right? So if I solve for that, I get this answer. I get that in that node, when the stock is when the stock is 75 cents, that node here or that node here is the same. The replicating portfolio, when you solve the system of equations, I give you the answer, is half a stock minus 25 cents of a loan, right?
Yeah.
Got it. Good. And because the stock is 75 cents, 0.5 times 75 cents minus 25 cents is 12.5 cents. You believe me? Yes? You can multiply. That's very simple accounting. That's it. Just to be sure, you know where the a half and the 0.25 come from, right? They are the replicating portfolio, and they always come from the same place, which is AS plus B capital B. That was the equation. AS plus B capital B, right? That has to be equal to the payout, which is 25 cents and nothing. That's the system of equations. You solve it, and I give you the answer. It's a system of equations 2 by 2. And that's where these numbers come from. Yes? I now know you understand. I now know you understand. You're an expert now. Yes? Sohyang, yes? You're an expert. Yes? I want to pause here until I get complete confirmation that everybody is with me.
Okay, sorry, I might be slow, but where do we get the? I understand the top part, but where did this the O equals the 125?
Oh, that's the value of the replicating portfolio. I just have to do the 75 times 0.5. Just do the multiply. This get any child in grade 3 can do this. So we get someone from grade 3. 75 times 0.5 minus 0.25.
Oh wait, oh, I see. Oh yeah, the stock is 0.5. I read it at 0 first for some reason.
Yes. Right? No, I told you, if you don't understand something, it's because you're there already. This is not complicated. We haven't seen anything complicated today. But I think it changes the way we think about financial markets. That was my objective. Your name? Olivia. I thought so. Okay. You understand? Yes? This is dynamic asset pricing theory. And we're all becoming experts at this. How do you do that? Same thing. Because I find my replicating portfolio, I know what the option is. The option, if the stock goes up, will give me 75 cents, and if the stock goes down, give me 12.5 cents. And some of you may be thinking, and this is good thinking, maybe thinking, wait a minute, that's not true. If the stock goes up, the stock doesn't give me anything. I have to wait until it matures to give me anything, and that's true. So I should change my English. I shouldn't say it gives me 75 cents because it seems that it's going to give me 75 cents in cash. No, it gives me a value of 75 cents, but it's the same. We don't distinguish between getting an asset which is worth 75 cents or getting 75 cents in cash or in Bitcoin, or we don't care. We don't care. 75 cents. And that's critical for our ability to build these theories. We're agnostic. Money, worth is worth. That's it. We don't care if it's in cash, with security, or crypto. We don't care. Right? So it's the same thing we've seen now so many times today. I have a stock that goes from $1 to $1.50 or 75 cents. If it goes up, I get 75 cents, and if it goes down, I get something else. You set up your system of equations, AS plus BB, two scenarios, two equations, two unknowns, A and B, you solve. Answer is 83 1/3 for A minus 50 for B. That's my replicating portfolio. We're sick and tired of systems of equations 2 by 2. We've done so many today. And the value of the replicating portfolio, given that my stock is $1, is 1/3. Yes?
A question related to the red triangle.
Yes.
Yeah, like how do you know the payout value of the two scenarios?
Because I've done it before.
AA plus BB equals...
No. Yeah. The payout is the value of the option when the stock goes up is 75 cents.
Oh, just there.
So it's there. We did it earlier.
Oh, wait. So 75 cents is on the right-hand side. So what is...
No. Okay. It is on the right-hand side, but we calculated it with the yellow triangle.
Yeah, I know.
Exactly. But that is critical. You understand that, right? We're back propagating. That means that if something was calculated earlier, continues to be valid. That's how I know the payout of my option, because I calculated that at a step before.
Yes. Yeah, but so if the right-hand side is 75%, what is the left-hand side? Yeah, it's
The right, sorry,
AS plus BB, what is A and B then?
A and B is, A is 83 1/3 and B is 50.5. I don't understand your question. AS plus BB was our basic equation for the replicating portfolio, right? And there's two equations depending on if I consider one scenario or another scenario, right? Okay, so the equal part is AB plus BB equals 0.75 in one case, and it's equal to 12.5 in the other case. So these are two equations, and that gives me A and B.
Oh, yeah, I thought my question is what is S and capital B?
What is S?
And capital B.
S is the stock, capital B is the bond, and the stock is worth,
1.5. Okay, I see.
and the stock is $1, and the bond is always, well, I mean, I'm assuming zero interest rates is $1. Yeah, he understands, I know that. I really want everybody to understand this. I'll miss my flight if you don't understand. Yes? Yes? So this thing not only prices the option, it actually tells me where my job will be for the future. So I know the work I have to do today. I also know the work I'll have to do tomorrow.
I think I got the same price for the option, but how come the A is 0.833?
How come?
Because isn't the system of equations 1.5A plus 1B equals 0.7?
Oh, I made a mistake?
I'm not sure.
It's possible I made a mistake. But what do you get?
I got the option price as 130, but
Yes.
I had 1.5A plus, so I got A equals 1/6, and then B equals
So
negative
A, for you, A is 1/6?
Yeah, and then B is negative a half.
Oh. Oh, B is a negative a half? So I made a mistake.
I might miss. I'll look at it.
It's funny that I made a mistake on only one. The same as him? Then I think you made a mistake. This is a great mistake. This is a mistake you should celebrate. How wonderful. That's good. That's a good mistake. Yes, keep making those mistakes. That's good. Yes. See, it's impossible that I can only make one numerical mistake. If I have to make two, right? If the answer for the option price is the same, I should make two, right?
Sorry, what is the system of equations?
What?
What is the system of equations?
It's always AS plus B equals the payout, right?
Yeah.
So the payout is either 75 or 12 and a half.
Yeah, and then in the first case, S is
In the first case, so
1.5.
right, so you solve for AS. So S is 1.5 in the first one, B is 1,
Yeah.
and in the second one, S is 0.75.
Yeah, okay, I just messed up.
Okay,
It's not
that's
right.
all right. Because the value of the stock is here in this. Yes? We're good? Okay. So on the dynamic asset pricing theory, I have nothing else to say until we become very bold and we start to develop a desire to trade continuously. But for now, we're good. I don't have to tell you that if instead of trading 2 times, I trade 5 times or 100 times, it's exactly the same. Now it gets really boring because you have to solve lots of replicating portfolios. Every time you have a binary branch, you have to solve a replicating portfolio. But we're good at it now. Yes, are we good? Now, the capital asset pricing theory, this is something which is, it follows a very different path forward. I don't know where your energy level is at this time. You need a break? Yes? Okay. Okay. We take a 10-minute break. Something tells me I should not push too hard on what we've learned today. Am I right? Okay, I guess I can lose you. So maybe what I'm going to do is assume that the content for today is what I just did. That's it. Okay, I need you to understand that. I need you to. I have a pretty good feeling that you got the story, the details. It's all good, right? I think it's also fair for me to assume that you've realized that many things which are in financial markets are really artifacts, and we don't need them here, at least not at this level. I think we've developed a theory which is very parsimonious, it's very minimalistic, and we've essentially concluded that things are really very easy because everything has to agree with everything else, and you just find the equations that correspond to those financial identities, and then everything follows. Am I right? Am I right? Good. The capital asset pricing model, what it does is it takes that way of thinking to the extreme, where it doesn't matter how many scenarios I have, it doesn't matter how many stocks, securities, bonds, options I have, it doesn't matter. Then you develop the theory of the unique price. That's what this is really all about. But I don't want, I'm a little bit, every year I have the same fear, which is that if I push too hard, then this nice construction we've built will shake. And I think maybe I'm not going to do too much. So maybe what I do is do one thing only, which is explain how, in the most pedantic way, I can refer to the 33-cent game using very complicated mathematical jargon. That's all. And then next week we will be free from the 33-cent game and we can look at this in its own merit. Okay? So the way we're going to be developing the theory is as follows. I'm going to consider a single period market. So think of the 33-cent game. Now, tomorrow. That's it. And I have possible events. And I use the notation from probability theory. But in my case, is stock goes up, stock goes down. 2. Right? But in general, I have a whole probability space. Infinite or finite, doesn't matter. The theory will be the same. Okay? So I'm only addressing today what we did today. Next week, we'll go beyond. We've also seen another example where we have 3 events. Stock goes up, stays constant, goes down. Right? That's it. These are the 2 things we have seen today. If we had 2 stocks, then I would have a natural measure space, which is what? Up, 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 down, down, up, down, down. But that's for next week. It's too complicated. We haven't seen it. Okay? So that's how we're going to be referring to what we've learned today. It's going to become a very big probability space. But for us, it was stock up, stock down. And of course, I'm not going to be referring to sigma algebras, but you know that the right way to do that would be with that. If you want sigma algebras at this level, sorry, wrong course. I refuse. I want you to understand stock up, stock down. And then we're good. Okay? Then we have another thing, which is what we call the payoff space, which is every time something happens, things have a value. We're going to do that with what's called the payout metrics. And the payout metrics for us are going to be very, very simple. I have a number of securities, 2, maybe 3, and a number of events, 2, maybe 3. So what instrument I does in scenario J, I call it Pij, a matrix. Because if you organize that information in an Excel spreadsheet, that's how it's going to come out. I warn you that, as it usually happens when you have matrices, it is not only a way to organize information, it will also give us arithmetic characteristics. And we're not going to be too surprised by that, because we already saw that the replicating portfolio was the solution of a system of equations. And you already know that a solution to a system of equations you can express as a matrix inversion and this and that. You've seen that, right? Right? Linear algebra, right? So if we organize our information correctly, then the matrix will also have arithmetic value, and we can multiply matrices and do things with matrices, and it'll make our life easier. But that's for next week, not for today. Today we develop the critical element there, which is that we can replicate financial contracts with systems of equations. I'm happy that you learned that today. Okay. Usually S naught, the first security is the bond, because it's the one that never changes value, or changes value in a deterministic way, but even we don't care. And this matrix is called the payout matrix. That's just language. I'm not doing anything new. I'm only touching on what we already did today, because that will be how we create the language of the capital asset pricing model. And there is another thing, which is the cost of those securities. When Henry offered to buy or sell option 1 for 33 cents, what he did is he turned a security that was a mystery into a security that has a price. And we've seen how important that is today, because when a security goes from being just an option that we need to price to a security with a market price, everything changes. In particular, that meant we have an additional dimension, an additional system of equation in our system of equations, and as a consequence, a unique price. Right? Right? That was his introduction of his willingness to sell that for 33 cents. So the cost vector is the vector of the price of all the securities whose prices I know. And just like you go to that website and you have bond prices, you can go to other websites or Bloomberg and get security prices. Those who have prices will be represented as part of my securities universe with payout matrices and cost vectors. And those who don't have a cost, who don't have a price, they are in the land of the to be calculated. And sometimes securities change, like 01 was in the land of to be calculated, and then suddenly it changed when he offered it for 33 cents into the land, the vector space of securities with prices. And it's a vector space because if I have two securities whose prices I know, the sum is also something whose price I know, right? Okay, so this is just me being pedantic, me writing or attempting to write in mathematical terms everything we have done today, because that's going to be the key for our ability to build the pricing theory in general. So we have financial instruments whose prices we know and their future prices are random. It was for most of our conversation today was the stock and a bond. But for a few seconds, we also had an option with exactly the same characteristics. And by the way, we don't care if they're stocks, options, or bonds. What we care is that they have a value under certain scenarios, and they have a cost. The rest, we don't care. We don't care if in the financial contract it says option, stock, bond. We don't care. We just care about their cash flows. If this was a course on securities law, we care. Oh, we care. But it's a math course, so a bond, a stock, an option, very completely different from a legal perspective. For us, show me the cash flows, and the rest we don't care. Okay? So because I'm not doing anything new, I'm just trying to explain what we've learned in a way that will be very useful for us next week, because next week that's the language I'm going to use. But I'll still be talking about the 33 cent game. The advantage is that when I use this language, the 33 cent game and your assignment number 1 will be the same thing. And that is worthwhile. If we can unify the 33 cent game with your assignment number 1, that's worthwhile, because then we understand how financial markets work, and we will see that bonds and options don't really make too much of a difference. We're just in control of the cash flows. So the payout matrix and the cost vector. And there's a certain linear structure here, because if I have financial instruments whose prices I know, as I said earlier, linear combinations of them, their prices I know too. Finance is simple in that if this costs $1 and this costs $3, when I put them together, it costs $4. I don't get volume discounts. So it's a very linear theory, and that's why it works. Right? Okay. So I think I'm going to just write my 33-cent game in this language and I quit for today. Okay? I think that's all I'm going to do. That's the payout metrics. Bond is my first column. Stock is my second column. That's how I organize my information. Anybody has any doubt with that? We've been playing with this matrix all day long. I just wrote it differently. But if I ask you to do this thing in Excel, not in Python, in Excel, that's how you would do it. It'll look like that. Your information would look like that. And your cost vector would look like that. It may be in a different part of your Excel sheet, right? That's how we organize the information. And then we see that the span of the columns of my payout matrix is all of the Euclidean space. That's how I know that I can price anything. These are things we already discussed today. I'm just writing them in mathematical form. Then we also had this stock that had that payout matrix. And there we know that the span of that is not everything. And that leads to incomplete information. For example, that payout is not in that span. By the way, if you give me a payout which is in the span, we can price it, and the price is unique. But it wasn't either of the two options that I presented to you today, not O1, not O2. Neither of them is in the linear span of the two securities whose prices I know, which is the bond and the stock. Okay? I'm summarizing in mathematical form what we've seen here today. But then Henry showed up and said, hey, wait a minute, I have a third of $1 here willing to buy option O1. Then everything changes, because then my payout matrix is this one, thanks to Henry. You see? That's what liquidities providers do. They increase your matrix by at least one column. And the cost vector associated with that is this. You always need a cost vector. Otherwise, the security is in the to be calculated realm, not in our securities universe realm. Okay? I'm not doing anything new. I'm writing in mathematical terms what we've seen today. So we are ready to develop the Uber theory, where it's just going to be able to do anything, doesn't matter what I have in my securities universe. Okay, all right. I think I'm not losing anybody. And then if I have to price my option O2, this is not in the dynamic exercise that we did. No. This is in the capital asset pricing model, because I have my third option, O1, with a 33-cent price. The span, all of the payouts of my matrix is all of the real line. Therefore, I can find the price of any other option, including O2. And I know how to do that because every payout can now be replicated, because the span of the columns of my payout matrix is all over 3. So every instrument can be written as a linear combination of the instruments for which I have a price. Do you get a sense that maybe I've been wasting your 3 hours today because this is all very easy now? Do you have that sense? No? Well, you will have that sense, because this is very, very easy. Now it's all becoming linear algebra, like linear algebra of the type that you have seen before. I'm not going to give you the general method for pricing and replicating. I stop here. I will start here next week. I have a feeling that I could break that string that's holding all your thoughts together. I don't want to break it, okay? Am I right? I'll start with, but if you reflect on what we've learned today, it's the simplest math class you ever had, since you learned how to solve systems of equations.